Hi, today's topic is the substitution effect. What is it and why is it so important? The term substitution effect was first raised in economic theory, and it had to do with the price mechanism, which is closely aligned to asset theory, but with one difference. We are not talking about a lesser product. We are talking about the same product or asset at a lower price. The substitution effect means that for any asset or investment you are planning to invest in, considering the substitution effect will prevent you from paying too much. Why? Because it will cause you to think, can I buy the same asset for a lower price, and why? And more importantly, it will prevent a narrow focus and will assist you to consider the wider markets, and will cause you to ask this question: what is holding this asset at its current level? In other words, what is holding the asset up? This will cause you to consider the current market value of tangible assets and the current market value of intangible assets, and it will give you a comprehensive understanding of the true value of all assets that you are considering buying or investing in. You must know what you are paying for each asset, and by so doing, you will be able to control your own destiny. You should be prepared to pay dollar for dollar for each tangible asset, and the only area of debate will be the amount you are prepared to pay for the intangible assets. You must be able to comprehend all values and compare them to current market activity at all times, to be able to live in a world of sanity and reason. You must know the market before you act. Knowledge will protect you. Don't expect selling agents to help you. They are working for the vendor, or should be. When it comes to business valuation, you must know the value of each asset, both tangible and intangible, to compare values. If you don't, it will be impossible for you to gauge the substitution effect. Comparing values in a graphic format is the only way to arrive at instantaneous concepts and numbers that can either be challenged, accepted, or discounted. Now, never trust a lease. In fact, never trust a tenancy or a lease. My advice is to look beyond the lease and ask yourself, what can I rent this property for if the tenant folds? And for the very astute, always consider the economic direction of the industry that your tenant is in. Now, I'd like you to see the illustration on the screen. And one of the big problems in this world today is that you can have two identical properties, basically $2 million properties. But the industry or the market values them at different values depending on the type of tenant. Blue chip tenants represent less than 5% of all commercial tenants out there. If you invest in $1 million property and pay $1.5K just because the tenant is considered blue chip, who does the extra value belong to? You or the tenant? If the tenant goes, so does the extra value, because it will be highly unlikely that you will be able to release to another blue chip tenant. Some advisors state you are buying the lease when investing in commercial properties. What utter bunkum. Consider the following case study. Many years ago, a large company leased a large warehouse building in a prominent commercial location to one of its subsidiaries for twice the market rental, and created a lease for 10 years with a right of renewal for another 10 years, and put the property up for auction with one of the large commercial realtors. An investor purchased the property at auction and paid considerably more than market value. He then settled and he did not receive any rent for 3 months. And at that time, the tenant declared themselves bankrupt and vacated the property. I was commissioned to auction off all the contents by public auction which occurred prior to the bankruptcy notice. I was then approached by the buyer to release the premises, which could only be done at or around market rental rates, not the inflated rentals on the lease. This buyer or investor lost big time. He lacked current market knowledge. If the rental stated in a lease is above market, then you will be paying too much. If the term is long or blue chip, you will be paying too much, and you will not be able to substitute the cash flow or value. In other words, you will lose. The substitution effect in valuation terms means, can you buy the same asset for lesser money? If the answer is yes, then to proceed with the original opportunity means that you do not mind paying a premium, but will harm or diminish your future. Thinking about the substitution effect, you will learn another concept called the price you should never pay. It is found in my book in chapter 11, and also look for the video on the subject. It simply means the price where you cannot get your money back. You will never value a business unless you profile and benchmark the revenue streams. You must profile to know where the revenue streams come from and who they belong to. If most of the money comes from a parent company, related party, or key personnel, you will be in trouble. Benchmarking, you must know the margins and the KPIs and the staff numbers and all the other things that indicate a business's position within an industry. This information only comes from market sources, and there is only one figure that allows true market comparison and is provable, and that is turnover, sales or services. What am I prepared to pay for this turnover rather than create it myself? The bottom line is, can I buy this asset or similar for a lower price? That concludes today's presentation. All this content can be found at valuationworld.org. Thanks for watching.